Welcome to this week's video. This week we've got a good one. It's the debt to equity ratio and what you should know. The debt to equity ratio really is an important ratio in your financial statements that's often overlooked in reviewing your financial results. So in this video I'm going to tell you what it is and what you need to know. But first, if you like these videos or get any value out of it, it'd be awesome if you could hit that like button and subscribe. Okay, let's get started. So the balance sheet is what I consider the Rodney Dangerfield of the financial statements. And what do I mean by that? Well, if you know anything about Rodney Dangerfield, he is famous for saying he doesn't get any respect. And if you don't know who he is, I encourage you, just look him up on YouTube. He's one of the best comedians that is out there, and has many years of just great comedy, and we miss him, but check him out. You'll definitely like him. But my point is that the balance sheet is often overlooked. You know, it's a financial statement that even some accountants don't even provide business owners with, and if they do, they don't even really understand what the balance sheet does. So one of the things that you can look at that's really important, especially if you're looking to get capital from a bank, is the balance sheet. You know, weak balance sheet is going to kill you right there. So it's critical for making sure that you understand what's important in the balance sheet and what you need to know. And one of the ratios that we're going to talk about today is the debt to equity ratio. And you should really look at the trends of the debt to equity ratio over a period of time. And on an annual basis would be good, or a 12-month like trailing review of the debt to equity ratio. So the debt to equity ratio measures the ability of the company to withstand adversity. And what that really means is it's taking a look at and seeing how much you have in your equity compared to your debt. And that ratio will kind of tell you whether the business is strong or it's weak. In other words, it's not generating enough equity or profits in the business to be able to fund the debt, and it may make it more risky or more safe depending on how that ratio looks. So think of it kind of like a home. When you go to buy a home, normally the bank will want you to put in and have some skin in the game, if you will, and put 20% down when you're buying a home or you're getting a loan from a bank. And it's kind of the same for a business. You want to be able to have skin in the game or equity in the game, that if you need in times of adversity or you want to grow or expand, you want to be able to show that, hey, there's money in this business, it's generating profit, and it's accumulated over a period of time. And that gives comfort to not only the company's ability to withstand adversity should economic times go down and the need for borrowing funds becomes more and more important, or for like expansion if you want to expand. So when you buy a home, you want to put some money down. The banks will normally require that. The formula for debt equity ratio is very simple. It's just your total liabilities divided by your total equity, and that gets you your debt to equity ratio. The higher the ratio, the less safe or more risky the business is, and I'll talk a little bit about that as well. So equity, just to review, equity is basically it's comprised of the investments that you've made in the business. Investments meaning the money that you put in or other partners have put in the business, less any distributions you may have made from the profits, and then plus your retained earnings, which is basically an accumulation of all the profit and losses over a period of time since the beginning of the business, really. You can also look at equity as your total assets minus your total liabilities. So in my analogy of a home, it's kind of like your equity in your home is the debt that you borrowed minus what you paid off. That's the equity. It does not equate to the value of your home minus what you owe. It's what you originally borrowed minus what you owe. So an example, let's say you're a company and you have $675,000 of total liabilities and your equity is $875. That would give you a debt to equity ratio of 0.77. And this is actually a really good ratio. This means that if you're a bank, that every dollar the owner has in the business, they have 77 cents. So actually the owner in this case has more than what the bank has. Like I mentioned earlier, a good debt to equity ratio is generally less than 2.5, and an excellent is 0.5. Actually 0 is probably good as well, but you get the point. But it really depends on the type of business you're in. So if you're in a restaurant, for example, a lot of capital is needed for a restaurant, and your debt to equity ratio might be higher. Auto repair shop, there's a lot of equipment that's involved in an auto repair shop, especially an auto body shop. Paint booths alone are quite expensive. So that ratio may be different, depends on your industry, and it's good to kind of look at a benchmark to see where you're at for your industry. And there's data out there that can kind of tell you what's a good debt to equity ratio for your particular industry. So the question then is, how do you fix the equity ratio? Let's say that you are looking to expand or you want to buy more equipment. You want to take a look at your debt to equity ratio to make sure you're prepared to be able to borrow funds when or if you're going to need that. So let's talk about how you would go about fixing it. And if you remember, we talked about what comprises equity. Equity is your investment plus your your earnings that you've accumulated in the business minus your distributions. So what can we do then? Well, we can improve profitability. That'll increase your accumulated earnings. That's a good one. You can keep earnings in the business. Maybe you adjust your draws temporarily to not take out money in the business. You can make an investment, put money into the business, and you could actually take, if you have any shareholder loans, loans that you made to the business, and you can put it in. You can convert it to equity or put it in equity to make that number higher. For banks, what they're going to do is, for the debt to equity ratio, what they're going to look at most likely is they're going to do kind of what I just referred to and look at shareholder loans. They're going to, if you loan your business money, they're probably going to look at that as equity, and they're probably going to add that to your equity in your balance sheet. The other thing that banks often do is they will look at the fixed assets. So if you're a really fixed asset intensive equipment that you have in your business, they're going to take that and add that to your equity. So that'll grow your equity as well. So in summary, debt to equity measures how well you could survive adversity. It's important if you're looking for capital, and it's also important to make sure that the health of your business is where you want it to be or where it should be. And in the future, if there's an economic downturn or something happens, that you'll have the ability to adjust and to maybe borrow some funds in your business. The trends are important to monitor to make sure that your debt to equity ratio is staying relatively consistent. And of course, you got to have good numbers to be able to make sure that those numbers are accurate when you're measuring the debt to equity ratio. So take a look at that as well. So that's all I got for this week. I really appreciate you taking time to watch this video. And if you like the video, hit that thumbs up. And I'd love to have you subscribe. And I will see you on the next one.